All right, ladies and gentlemen, welcome back. Buckle up. What's unfolding right now at UBS Group is nothing short of a financial horror show that could make everybody's jaw drop. Now, this is a screaming red flag, okay? The Swiss banking titan, UBS, has been slapped with a chilling adverse opinion from their auditors. Right, we're talking their financial auditors, the people that are delving deep into their books, called Ernst & Young, which is a world famous auditing company. Now, regarding their internal controls over their financial reporting for 2024. Again, this is not a polite nudge. This is a screaming red flag that the banks cooking the books and just may be a house of cards teetering on the edge of collapse. What is happening here is astronomical. If you haven't watched the video we did a couple days ago, the live stream about UBS and Credit Suisse and Citadel, you have to watch that. I'll put a link to it at the top right now on a video card. But let's peel back the layers here on the nightmare that is UBS, Credit Suisse, Archegos, and their over-leveraged positions. What is the root of this catastrophe? It was the $3.2 billion acquisition of Credit Suisse. It's a deal that was supposed to solidify UBS as a dominant player, but instead is unleashing a Pandora's box of chaos, if you will. Now, Credit Suisse didn't just bring assets to the table. There's a reason UBS got such a great deal when buying Credit Suisse. They dragged along a huge, festering pile of lies, toxicity, and bullshit and reporting deficiencies that UBS has completely failed to clean up. Imagine inheriting a mansion and you find out that it's infested with termites and the walls are falling apart from within and the foundation's crumbling out from under your feet. That's what's happening to UBS, guys. Ernst & Young, they didn't sugarcoat this, all right? They said UBS has not maintained effective internal control over financial reporting. That means that for a bank of this size, of this magnitude, it's not just embarrassing, it's a potential stake in the heart, the final nail in the coffin. So really here, folks, the shock deepens when you realize how rare this is. To hear an adverse opinion from these guys is not just some casual critique. It is the equivalent of a 5-alarm fire. And for a major international player like UBS, which has a market cap of $107 billion and a stock that's up 8% over the past year, this is a scandal that could actually unravel everything that's going on right now. And a big part of that is the main part of that is their takeover of Credit Suisse. And all of the toxic liabilities that were held there due to their over-leveraged swaps and short positions against companies like GameStop and AMC. You know, investors right now in UBS are relying on these financial statements to be the actual truth, the gospel, if you will. And they're being told that these numbers are fake. They're a mirage. Now, were they misrepresented? Are they misstatements? Are they lies? Now, you can pick your poison here, because any one of those possibilities is going to tank the confidence of this stock much faster than anybody can actually place a sell order. Let's put it that way. Now, this is where it actually gets terrifying. This is nothing new, guys, ladies and gentlemen. Hey, Pearson, let me interrupt for 1 second. Pearson says, I'm a new Lit Exchange investor, very excited for the future. Welcome to Lit Exchange, my friend. I'm very much looking forward to working with you and everybody else on this upcoming stock and crypto brokerage. Here's where this for UBS and the global economy, people with pensions and 401ks, actually start seeing major problems. Credit Suisse's 2022 annual report already had explicit warnings from their auditor, which is known as PwC, about their weak internal controls. Now, UBS knew they were buying a ticking time bomb. That's why they forced the Swiss government to give them an $8 billion bailout in case of a certain number of losses from the takeover of Credit Suisse. But here we are 2 years later, and that bomb is still ticking, folks. And it's louder than ever. Tick-tock. SEC was sniffing around, smelling Credit Suisse's cash flow back in 2022 under their former CFO, wondering whether share-based compensation and other shady accounting moves were actually the right move. Now, UBS's current CFO, who inherited this hot mess, looks like he's been caught flat-footed doing much of the same. Did they underestimate the toxicity? Were they too arrogant to think that they couldn't fix it? The stench of incompetence here is overwhelming, folks. And the fallout potential is mind-boggling. Nobody really understands just how big this is going to be, especially those that are not paying attention. But if you have been, you'd realize that some of these heavily shorted equities, well, the swaps eventually need to be unwound. And even FINMA, which is basically the FINRA equivalent in Switzerland, are supposedly in intense contact with UBS about this right now. You can see here that they're directly referencing the takeover of Credit Suisse as to a big portion of the issue. They are bracing here for a systemic shock. UBS isn't some little corner bank, isn't some mom and pop shop. They're a cornerstone of the global finance sector, guys. And if this is a lie, what they've been saying in their books, the ripple effects are going to hit markets worldwide. Investors are going to they're going to flee. They're going to run away without question. They're going to sell faster than you can hit the sell button. The regulators are going to clamp down on these guys, and the compliance costs are going to absolutely skyrocket. Now, the losses, that's going to be exponential. Let's not forget $17 billion of Credit Suisse debt that was wiped out. And that's already sparked a $225 million lawsuit from, I think, Alliance Bernstein. And that's proof that there's already blood in the water. Now, UBS CEO has been out there warning against excessive regulation just as this scandal here is broken. And I think it's very important to note that at this very same time, we're looking at the delisting of a vast number of gold and silver futures contracts. And we're going to talk about that shortly here and how that actually all links together to create a big financial meltdown, sadly, for many people. And you know what? Who's going to be hurt here? Everybody, not the big banks. Big banks aren't going to need the bailouts. It's your pension that's going to need the bailouts. Your 401k, your IRA, your thrift savings plan, your ISA. You think that Roth is safe? Sorry, my friend, it's not. And I'll explain exactly why. And I've even got a short video here from someone else that does a great job of explaining it. And she's very passionate, so I'm going to let that speak for itself. But here, the irony here with this Swiss bank is thicker than Swiss chocolate, if you will. Here's a bank that can't keep their own house in order, but they're preaching about the freedom from oversight, from excessive regulation. It's like a fox guarding a hen house after they've already eaten half the fucking flock. Now, there's posts all over the place on X with people that are in disbelief about this. And a lot of people are accusing UBS of cooking their books for years, just like we have been doing on this very same channel. And of course, Credit Suisse was doing the same thing. And look at what happened to them. It may have taken Archegos to help Credit Suisse melt down, but now we've got Credit Suisse to help UBS melt down even further. So whether the actual cooking of the books is hyperbole or truth, the perception is going to be devastating, folks. Glizzy, he says the SEC's got the big sniffer. In short, it's a gut punch, folks, to UBS's credibility. And it's not just the auditor's findings, it's the massive sheer scale of what's at stake in the financial sector. And for everybody, this is a huge cesspool of toxicity. And it's a financial nightmare for UBS. Now let's dive into this bombshell here that we're seeing with CME Group. CME Group is delisting gold and silver futures contracts on the COMEX, which is likely a seismic event in the commodities market that could send shockwaves throughout the financial sector. So we've got this special executive report from CME Group dated March 14th, 2025. They're announcing the immediate delisting of several key futures contracts: gold kilo futures, London spot gold futures, London spot silver futures, and cleared OTC London gold forwards contracts. These are collateral margin contracts. And the implications here are also staggering, and the timing being right on the heels of UBS's financial control debacle further amplifies the sense of unease that we've been seeing here, folks. The CME Group operates the COMEX, the Commodities Exchange Inc. And pulling the plug on these contracts, effective immediately, we're looking at the futures contracts for gold measured in kilos, which is massively used by institutional investors and traders, gone. The London spot gold futures, which track the spot price of gold in London, which is, of course, a global benchmark for precious metals, in case you don't aware, gone. The London spot silver futures, which are same as gold but for silver, another safe haven during market turmoil, gone. And then the cleared OTC London gold forwards, the over-the-counter forward contracts for gold, cleared through the COMEX, used for hedging and speculative purposes with leverage, gone. And the report here notes that there's no open interest in these contracts, meaning that nobody holds positions in them. That's a huge red flag too. Why are these contracts that are tied to gold and silver, two of the most historically significant and sought-after commodities, precious metals, sitting empty, especially as gold hits new all-time highs of $3,000 an ounce? That's a problem. This isn't just a minor move by the COMEX, guys. It's a big problem for metals markets and for markets in general. Gold and silver futures are the go-to for people and investors looking for safety during economic turmoil, during uncertainty. And with UBS under fire, revealing the potential systemic risks in global banking, you'd expect that investors would flock to precious metals. That's why we're looking at gold over $3,000 an ounce and silver licking $35 an ounce now again as well. But the COMEX delisting these contracts at a time when confidence in these financial institutions is already shaky, well, the absence there of the open interest suggests that there's either a lack of trust in the contracts themselves or a deliberate move to suppress trading in physical-backed assets, because that's what these are. This obviously could be interpreted as a signal that the market is being manipulated to steer investors away from gold and silver, if you will, to prevent the price from going higher, which has long been a conspiracy theory that's haunted the precious metal space, especially when you take into consideration the fact that 96% of all precious metals trades take place in dark pools of the derivatives handled by big banks. 96%. So this paints a picture of a financial system that's on the edge, folks. UBS auditors flagged severe issues with financial reporting, hinting at potential misstatements. Now the COMEX is pulling gold and silver futures, the assets that investors usually run off to when the banks look pretty shitty. The coincidence is jarring. Is this possibly a broader crisis where physical assets like gold and silver are being sidelined to prop up the confidence in paper-based financial systems? The optics here are terrible, and the timing is off as well. Now, there's another post that I haven't pulled up yet that I actually should, and so I'm going to go ahead and search for it real quick regarding the DTCC. If anybody's got a link to it, let me know. And they're making some huge changes, let's put it that way. They're basically trying to make bailouts easier. Let me see if I can find that. They're changing the rules to what constitutes a market disruption. Welcome to the channel, my friend. The DTCC is changing the rules of what constitutes a market disruption. This allows them to anticipate when a disruption is going to happen and take preventative action. And you don't have to take my word for it. Here it is. It's for you to check out for yourself. This is a notice dated March 14th. Ironically, the exact same day that CME Group came out with this delisting of the gold and silver futures. Now, the text is a little small, so I will tell you that it says the purpose of the proposed rule change is to amend rules regarding systems disconnect, threat of significant impact to the corporation's systems. By corporation, they mean the DTCC, as well as the FICC, their affiliate clearing agencies, and the National Securities Clearing Corp, the NSCC. They say the current disruption rules contain provisions identifying the events or circumstances that would be considered a major event or systems disruption. During the pendency of a major event, the disruption rules authorize the clearing agencies to take certain actions to mitigate the effect of the major event on the clearing agencies. And they more broadly would update and add definitions used throughout, update the provenance, etc., add provisions incorporated for reporting and testing, and so on. And the real important part here is, although similar to the existing definition, the new definition focuses more appropriately on what has actually happened or is reasonably anticipated to happen to the DTCC system's participant system, and less on subsequent operation of the system. For example, it is possible that a DTC system's participant system is corrupted or compromised, but that corruption or compromise has not affected the normal operation of the system at this time. Folks, they are well aware of that something big is coming, whether that be a massive market correction, a meltdown of large banks in the sector, or massive changes in the volatility index or in precious metals. The fact remains that someone's going to get bailed out. And I really like the way that Tiffany Cianci here explained it, because it's very simple for those that are unaware. She explains it very eloquently. And she references regarding, how Joann's and Forever 21 and all these other companies, Party City, are collapsing. A lot of you would say, well, they're garbage companies. Well, that's not the case. Joann Fabrics is highly profitable, by the way. I know it sounds weird, but it's the truth. And she says this isn't just retail struggling, it's financial arson. Private equity rigged the system. They built a time bomb, and now it's detonating. A mega threat. Now, this is a fantastic 8-minute long informational-filled rant from her that I'm actually going to play out. But before I do, you need to go follow that link to Lit Exchange, folks, because a lot of that could be a much less risky, potentially much less risky situation than what you're currently seeing in financial markets. Now, that's not financial advice in any way, but you do have the opportunity to own an upcoming stock and crypto brokerage for the first time in the history of the world. Remember, no company ever has given you the opportunity to invest in it as an upcoming stock and crypto brokerage before its launch and before its IPO. Lit Exchange is the first.
Last night, I started off by researching Hooters getting bankrupted by private equity and ended up uncovering the next 2008 level economic collapse. And they're hiding the bubble inside a private equity black box that makes it almost impossible to see what they're doing. Almost. This time, they're not going to collapse the banks and make it too big to fail. They're going to bankrupt the entire American pension system. I'm almost too afraid to make this video, but it has to be done, so let's get into it. In 2008, investors and bankers were able to crash the world's economy by engaging in risky, unethical bets and investments, and they did it right out in the open. They've learned, and this time they're doing it again. Bigger investments, bigger risks, same playbook, but they're doing it behind the smokescreen of private equity in bigger numbers. They're creating a bigger bubble than before, and it's not somewhere down the road. It's here, and it's about to pop. You see, for the last month, I've been trying to figure out why these companies that private equity had acquired were failing even though they were still succeeding. Joann's, 97% of their stores are still profitable, and yet they're still bankrupt. But they weren't bankrupt a year ago, and they still had the debt that private equity had stacked on them a year ago. So I wanted to know what changed. The same thing with Hooters. The same thing with... Now in 2024, private equity bankrupted 110 businesses. And that was almost double their previous record. There had been huge increases in the amount of bankruptcies each year over the past 3 years. But I didn't know what had changed because private equity had held many of these businesses for several years and they were still succeeding. Until I got my hands on an economic report and an article and found a term that nobody could explain to me. The term was back floating rate loans.
I love it when people start to figure this stuff out. We've been talking about it on this channel for a significantly long period of time, but to hear others talking about it really gives you a clear indication that people understand, or are at least starting to understand, what's going on out there. That a lot of what you're seeing on the stock market and the financial markets is a huge fucking lie.
I didn't know what that meant, and no article would explain it to me. So I had to go and do research in the financial prospectuses of a bunch of financial investment firms. Guys, in the last few years, private equity has taken out $3.8 trillion in adjustable rate loans. These are adjustable rate loans. These private equity firms took out adjustable rate loans. And so for the last 3 years, as our interest rates have gone up, every 30 to 60 days, the money due on the loans they stacked on top of these companies has gone up every 30 to 60 days. That's why these successful companies that private equity had acquired are suddenly bankrupt, even though they're still making money. They're bankrupt because they're paying adjustable rate loans. But it doesn't stop there. It gets so much worse because my next question is, why are the banks willing to give these risky loans to these private equity firms knowing it's going to cause them to fail? And the answer is because the banks aren't going to keep them on their books. The banks are immediately repackaging these adjustable rate loans as something called CLOs, right? Which are then packaged and sold off to our pension funds as really great debt. And they tell them that it's a diversified portfolio. Are you hearing The Big Short in real time? Literally, all of these companies are getting bankrupt.
She's talking about collateralized loan obligations. And it's basically a product that it manages a large pool of loans. That's the same thing that we saw in 2008 with the housing crisis. And a lot of that has just changed slightly into a lot of the same. Let's put it that way. It's a lot of the same. And don't believe that, overvalued housing then was the big issue. The reality was that it was speculation. Speculation from people that had more than one property, that took out a lot of ninja loans, no income, no job verification loans, which was why it stands for Ninja, Ninja. And the same thing has happened now, except instead of long-term LTRs, long-term rentals, they're STRs, short-term rentals, Airbnbs, VRBOs, etc. And then you add in everything else going on with the banks, and we've got a significantly huge problem on our hands.
Bankrupted in greater and greater numbers. And all of this debt is adjustable rate. And all of the bankruptcies are skyrocketing in this direction. And now, if you look at this graph, you can see that aside from 2020, which is obviously an anomaly, right now, private equity, that's the yellow section,
graph.
has double the highest number of bankruptcies they'd ever had prior to last year. And that number is climbing this year. $3.8 trillion. $3.8 trillion in this debt. Okay? I want you to look back to 2008. Do you want to know how many risky adjustable rate mortgages there were?
1.3.
$1.1 trillion. Do you want to know how many subprime but not quite as bad loans there were? $1.3 trillion. That was just in housing. In the $3.8 trillion held by private equity, they own the largest shares of the home ownership market in the United States, but they also own the daycares. They own the veterinary clinics. They own the pet stores. They own the nursing homes. They own the emergency rooms. They own the doctor's offices, the orthodontists. They own the builders. They own the HVAC companies. This isn't just housing. It's going to touch every single industry around us. And that is why, if this were a free market and private equity had not exploitatively gotten involved, if we had a free market and we could see what they were doing, these companies would be succeeding. If this were actually a free market, these companies would be succeeding. Joann's has 97% of their stores profitable. That is an astronomical number. 97% of a retail store is profitable, and they are failing and they are closing every store. And it is further consolidating an already consolidated environment. And now there are thousands and thousands of employees that will not have jobs. And there are thousands of other businesses that are going through the exact same thing right now. And why? Because they know we will never allow the banks to be bailed out again. We would literally riot in the streets. But we're definitely going to allow them to bail out the pensions because that's our grandparents. That's our parents. That's the working class. They know that this will get bailed out. And because there's no regulatory authority, there are no laws stopping private equity from doing whatever they want, they know they can get away with it.
How does this work? Folks, private equity takes your parents and grandparents and your pensions, your 401ks, and your thrift savings plans, your IRAs, your ISAs, and they invest them wherever the heck they want. So, as more of these firms go bankrupt, well, the pensions blow up, the 401ks and the thrift savings plans and the Roths and all that good stuff. And then instead of bailing out the big banks, which is likely to happen anyway, because they're too big to fail, they're also going to have to bail out you and your parents and your grandparents, kids, because of the vast issues we've been seeing in financial markets for a long time. Now, the good news is we did see U.S. Treasury Secretary Scott Bessent come out today and say that the United States is heating off a financial meltdown. Slight change in the words there. Maybe he didn't use meltdown, but a financial crisis, he said. He did say that the United States is currently heating off a financial crisis, and that's thanks to all the changes that are currently happening under the Trump administration and the what DOGE, the Department of Government Efficiency, is doing in cracking down on illicit, ridiculous, fraudulent government spending. But there's a long way to go.
And we can't do anything to stop them.
She continues, and I'm going to let her finish here.
This was done by blatant, intentional greed. The private equity firms wanted the cheapest debt they could get, and they believed, arrogantly, that the debt would stay cheap forever. They had 0% interest rate loans for ages. And so they took on these adjustable rate notes thinking they could keep refinancing forever out of it. It was arrogant. But it also meant that they got to collect bigger fees because they were taking risky debt that cost less. The bankers were happy to give them because they got higher fees on offering bad debt. They were going to get paid no matter what. At the same time, the private equity firms mandated in their contracts with these companies they acquired that they were advisors and that they were a management company. So they also get paid that way. And then they sold the land out from under these companies and all their assets and made themselves whole before any of this even began. They're already cash positive.
That is how it works.
The banks knew they wouldn't be held accountable because they were going to bundle it up and pass it off to the pensions. And even the pensions were reckless because they're buying these mechanisms because when you purchase into private equity, when you purchase private equity debt as a pension, you get to put on your books, especially if you have an underfunded pension, the projected gains for 10 years, which means for 10 years, it looks like that pension is more shored up than it is.
The reason is because you're investing in a company that has a lot of debt. And I'm not talking about a company with high cash flow and high revenue, like some big names out there. I'm talking about some other companies out there that have growing debt, increasing debt, not companies that are paying off their debt. And what the pension does is they pay some of that debt, they invest in it, and then they get to basically cook their books using what the projected profits over the next decade are going to be. But what happens when that company, which already has growing debt, runs out of money, which obviously if they're in debt, they already have, they're using your investment. All they have to come to you, ask you for more money and hope that you'll give it to them as a pension. And if not, well then, if they go bankrupt, that pension just lost all of those funds.
And at the end of that 10 years, when it's time for that fund to close out, suddenly then all of the bad debt comes crashing down on the pension. But at that point, there's a new leader on the pension fund and they've kicked the can down the road. So even they were reckless. But at the bottom of all of this is the bankrupting of the fabric of our society. We are losing our businesses. We are losing our doctors. We are losing our orthodontists. We are losing our nursing homes. We are losing our funeral homes. And one by one, they're going to fall under the weight of this really horrible adjustable rate debt. And nobody is talking about it. I could only find 2 articles in very obscure financial magazines that even talk about these back floating rate loans. I have never been more terrified. And I talk about private equity a lot. I have a lot to say. But right now, all I want to do is get someone to pay attention that can make a difference in this, because we have a problem. We're not without any hope at all. Right now, private equity is only allowed to be this exploitative because they exist
Carried
under something
interest.
called the carried interest loophole, something that multiple Congresses have tried to close, but private equity continues to bribe politicians to fail to actually achieve. Trump, 3 weeks ago, said he wanted to close the carried interest loophole. I thought he was doing it as a fundraising maneuver. But he's doubled down on it repeatedly. If we can make enough noise about this, maybe we can get him to actually see it through and end private equity's stranglehold on our population. There's so much more that we have to go through, so this is going to be a multi-part series, but maneuver.
Carried interest is a big problem, and to have Trump close it out would, of course, be a fantastic thing to see. As we mentioned to you guys moments ago, the issues that we're currently seeing with UBS from their takeover of Credit Suisse is only going to be exacerbated. It is not going to go away. This is something that has been coming for a long time. And as firms like UBS need more cash or need to properly collateralize because they've been cooking the books for way too long, they're going to have to fire sale some assets. And when that happens, there's a likelihood that some of these pod shops and hedge funds and family offices, etc., that we talked about in the last video we did, the last live stream we did just a couple days ago, are going to have to also fire sale some of their positions, leading to further deterioration in financial markets, and then possibly some significant short squeezes in heavily shorted equities and precious metals. I'll leave it at that. Cheers, ladies and gentlemen. Go check out Lit Exchange. You don't have to put your money into a pension, which is going to go buy some company's shitty debt. You can actually invest in private equity yourself in a company that has no debt by investing in Lit Exchange. Cheers, my friends. I wish you peace.